Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our good friend Hugh Hendry, the asset capitalist and the former CIO founder of Eclectica Global Macro Fund that ran for 15 years. It's welcome back, Hugh. It's a huge pleasure.
Oh, always fun. I'm super stoked. You find me. I'm in my friend's TV studio. Like we're selling beautiful cream, Josie Moran. I mean, and the ladies love it. I mean, it's better than macro policy. It's so thin. You push it on. Anyway, what are we here to discuss today?
So we have recessions being called the past month or two from Germany all the way to New Zealand. There's so much turmoil in the markets and uncertainty, Hugh. What's going on out there? What are you watching?
What's going on, brother? Let's go, Marvin Gaye. Yeah, we're watching the latest policy error, from the Federal Reserve. Easy to say. We have a problem. Central bankers are not measuring money. They're not looking at money. They're ignoring monetary markets, the money markets. The money markets in terms of like the 2 year, the 10 year, the inversion, they see the consequences of the error, which would be a recession. The recession's become palpable in places like Germany, as you reference.
Mhm.
Um, and the Federal Reserve is it's like taking it's the deer hunter, and Jay Powell's like putting a gun to his head, and he's spinning the revolver, and he's like, click, click, I'm going to raise rates again. And,
Yeah,
and, and
exactly.
I'm like, gee, you guys are crazy. I'm out of here. I'm back. I'm back. So,
Uh,
they don't measure. Okay, so um, balance sheet, right? Federal Reserve, quantitative easing. Okay, what is Fed? Let's do quantitative easing, and let's try and reveal it if we can in simple terms. So I am the private sector. I sell a treasury to the Federal Reserve. I receive cash back, cash settlement, and therefore my deposit at my bank goes up. That is a liability for my bank. Okay, the
mhm.
bank on the asset side, it receives a reserve from the Federal Reserve. And so everything is back in balance. Okay. Um, in terms of money creation, the bank needs to go, you know what? I'm feeling good about life. I want to take more risk. I'm looking for a big bonus. I'm going to make a loan
Right.
in the real world. That's not happening. We have a situation where the banks are sitting, the US banking sector is sitting on hundreds of billions of dollars of unmarked, uh, unrealized loss. So they are marked, forgive me, but they're unrealized and they're not being recorded through the income statement.
Right.
Bank of America confessed just 10 days ago that it has an unrealized loss of $100 billion. And that would be about 35% of shareholder funds. Okay.
Wow.
And I call that a fragile equilibrium. Okay. And let's put it into reverse. So the Fed is now doing quantitative tightening. Okay. So quantitative tightening, the Fed is selling me a piece of financial paper. And so my deposits at the bank are going to go down.
Mhm.
Okay. And then the reserve with the central bank is again going to make the corresponding adjustment. But it's the movement in the deposits which is my concern. At the same time, Russian roulette Jay is saying, we got a recession. I'm going to raise rates 2 more times. Okay,
Yeah.
so problem there is that the competition for yield outside the banking sector, money market funds et al. I mean, if you go into a muni fund, you get like 7% on short maturities. And the Fed's like just what it's doing, quantitative easing is taking deposits out of the banking sector. And
Mhm.
then raising rates is making it more desirable for the citizens of America to go chase yield outside the banking sector. So the more that we take money outside the banking sector, the more and more it becomes an acute problem of potentially having to market the losses of the banks on these hold to maturity portfolios. The Fed is the regulator. The Fed knows this,
Mhm.
and yet the Fed is taking this risk. I don't understand why.
Yeah, and I seen an article recently of Goldman Sachs and many other banks. They're cutting like their main managing directors, over 125 of them globally. You see JP Morgan and Citi are also cutting investment banking headcounts. So what are these banks preparing for? Are they just preparing for the ultimate recession that's inevitable, that's happening? What do you think, Hugh?
I mean, they're trying to survive.
Yeah,
Yeah.
there you go.
Um, so what is shocking is that we've had three large banks um, evaporate before the recession. Okay,
Wow.
the charge, the credit, you make a provision for bad debts as a bank. Okay, and presently that charge, which is taken against profits, can be measured in basis points. Hundreds of a percentage of one percentage point.
Hmm.
Um, when the recession hits, it'll be 2-3 percentage points. And that in itself will be a huge hit to banking profitability. So everyone knows, the yield curve inversion knows, the banks letting go of staff. The banks are already contracting credit. They don't want to make loans. Everyone knows, everyone's preparing to deal with the consequences of the policy. Inflation, is going to be closer to 2%, I believe, over the course of the next 12 months. And the danger might be that it slips further.
Right.
That's what they're preparing for.
And what are you looking at that will have huge upside with all this uncertainty in the market? Is it gold, or what are you looking at right now?
Well, I mean, heavens, looking for huge upside when the world is perilous is it a fool's errand? But you noted prognostications, the dismal science of trying to look into the immediate future.
Hmm.
And being folk like me calling on a recession. Heavens, we had a technical recession the first 2 quarters of last year. Okay. So that's what, 18 months ago. And bozos like me be like, duck, cover, duck, cover. And people are like, get
Yeah.
out of here, get
Yeah,
out.
that's right.
You're so yesterday. And they forget, the Federal Reserve uh, it cut interest rates in September of 2007 with stocks at an all-time high.
Mm.
There's momentum in stocks, but there sure as hell ain't no wisdom in stocks.
Yeah, that's
But
right.
to answer your question, I'm living a very charmed life here in my beauty studio because I get the kind of quadratic expression of macro. So there is uncertainty, you know. Um, a super tanker is turning slowly, but when it turns, it will have devastating impact. So, just now, like funky NASDAQ AI stocks are going up. Okay.
Hmm.
So if I had $1 million, if I had $1 million, I'd 150, maybe 200,000 in, NASDAQ. Um, I'd have 200,000 in Bitcoin. And I'm just sorry, forgive me, I've just jumped quadratically. So I was doing equities. So within equities, I've got $1 million, and maybe I'd have $150,000 of that million in
Right.
equity and in Nasdaq equities. If we go into the second quadrant, which would be riskless or government fixed income securities, I really want to own them. But the thing that's kept me charming and endearing over the years is I only buy shit that's going up.
Yeah,
And
that's good.
the only thing that's going up in bonds is the yield, which is to say the price is dropping. Uh, so how do we cross? Do you cross a canyon of despair with hope, or do you deploy optionality? So, I've been buying a very, very simple 100 strike call on the TLT, the long duration ETF for
Right.
US securities. I think present price is probably 97, 98. So it's kind of close to at the money, but I'm buying it with an exercise of January 2025. I'm buying it with 18 months. So I'm a bozo. I know something's going to happen, but I can't tell you the month. I don't know the birthday of the recession, which is
Right.
coming. Okay. So in $1 million portfolio, I'd probably spend like 70, $80,000 on call option. And I should probably do better. I should probably sell a 103 and buy the 100. I should roll it every 45 days, but whatever. You get the gist.
Yeah,
Then into
absolutely.
the alternative space, and here we are. I mean, we've got to discuss the name of your podcast. I mean, the silver thing seems like a relic. I mean, it's only the really bad people who are in silver. Silver is an abusive relationship. It just treats you poorly. You love it, and it just gives you nothing.
It is an abusive relationship. I could agree.
But in that quadratic zone of alternatives, yeah, silver, gold,
Hmm.
uh, treasury, inflation protected securities, private equity, commercial and residential property, Bitcoin. Presently, I put yeah, I I put 200,000 into Bitcoin, and I've told you before I do so because that quadrant of alternatives, it's at least $100 trillion of
Right,
market value, like the
right,
alternative space, and Bitcoin is like 0.5. I'm not including all the shitty coins and the crypto, just
right. Just the main ones.
Bitcoin commodity is $500 billion. And it might go to 15 or 10, right? But
Hmm.
it might also go to 100,000. And those kind of payoff ratios, I'm like, yeah, you know what? $1 million, I'm putting 200,000 into Bitcoin. Okay. And then what have I spent? I've spent 150,000 on NASDAQ, 200,000 on Bitcoin. I bought my Bitcoin. I bought my Bitcoin via Grayscale Trust. So I'm cheap, I'm Scottish, and I think the discount is real. I think the asset is real. We'll see. And so I'm buying it cheap. So I've spent 350,000 bucks. I spent 70,000 bucks on the option to own the treasuries. So
Okay.
I'm at 420. Now I've got what? I've got $580,000 of cash. And I'm sitting in money markets getting 5 plus. I'm in the 2 year getting 5%. Yeah.
Hmm.
And I probably scalp some of that and I'll go to my futures trade and I'll say, hey, listen, I'm going to pony up like $30,000, right? I want to be long the dollar and short the Chinese renminbi. Okay. That's my portfolio. And it's kind of cool.
Yeah, it makes sense.
I'll make changes. I think inevitably I will have to cut the stock part of the portfolio.
Right.
I believe inevitably I'll have to actually come in and actually buy government bonds when the recession. But the time for that is when we got lots of time. When the Fed pivots, okay?
Yeah.
When the Fed cuts, you talked about making a lot of money. I mean, honey, I'm gonna make a lot of money when the Fed cuts rates.
Absolutely.
That's when I'm going to take my risk. All this preemptive. I mean, yeah, I don't have to tell you the secrets of the bedroom. You never want to be premature,
Yeah,
you know,
exactly.
be on point. Okay. And so wait until the bozos recognize their error and they're like, oh yeah, we're going to cut rates by 25, and then it'll be 50, and then it'll be 75, and then there'll be
Yeah.
3 cuts a week.
Oh yeah, they'll keep cutting. Absolutely. And do you think the contagion from the banking crisis, Hugh, will spread to commercial real estate or other sectors?
Of course it will. Of course it will.
Wow.
Um, there is a profound shortage of housing stock, family housing stock. We just didn't build since 2008.
Hmm.
And so you can see house builders kind of look jiggy to the upside. Um, and then what adds to their appeal is that they make a lot of money in building and selling you the house. And
Hmm.
so they can lose money on giving you like a teaser rate, So
Right, right.
but in the real world, there are no housing transactions. They're just housing transactions have stopped. Why? Because like a new mortgage is going to cost you 7.5%.
Yeah, it's
You know,
ridiculous.
when we were buying houses, when we were speculating and spinning houses in 21 and 22, like the 30 year was 3%. So the size of the house you could buy then was enormous. Today, you're buying a matchbox,
Yeah,
so
it's
nothing
sad.
happening. But when it comes to happen, there will be a distressed seller at some point that says, "Oh my God, I know this is the wrong price. I know I'm going to take a loss, but I need liquidity."
Right.
Then you'll get a mark, and then the banks will go, "Oh God," and then they'll have to pull. And so it's a known. We just haven't seen the transactions, but for sure we'll see the transactions in the housing market in the
Absolutely.
and market.
Absolutely. Well, Hugh, it's been such a huge pleasure having you come down to Wall Street Silver. It's always great having you on. What's your last words for the community before you go?
Um, Glimmer and glow. Okay, like don't let the Fed and its policy errors like make you angry.
Oh,
Just
yeah, don't let it
be
depress you.
be smart. There's opportunities, and follow the wise people.
Absolutely. Well, thank you so much, Hugh. It's absolutely been a huge pleasure having you on. And hopefully, as the market develops, we can have you back on to Wall Street Silver to talk about what Jerome Powell is doing.
Absolutely. I'd
Awesome.
love
Talk to you soon.